Hey real estate professionals, welcome to our new reality in real estate don't get blindsided video. You know, just when you thought you'd worked all the changes that have happened in lending into your business practices, here comes another round of lending changes that are highly likely to greatly impact your clients and how you conduct your business. Have your current lending partners updated you on them yet? Well, I'm doing these videos so you won't get blindsided by the continuing sweeping changes in the mortgage industry. At the end of this video, you'll have the opportunity to subscribe to our continuing video series to help keep you up on the coming changes in mortgage lending that can impact your business. And before we get into this, let me introduce myself. My name is Kurt Jackson. I'm a certified mortgage planner in Liberty with more than 18 years in the mortgage industry. And I'm here today to basically just kind of go over the changes that are likely to impact all your buyers and sellers that use financing to either purchase a house, or the buyers of a seller's house uses financing to purchase a house going forward. See, the government's making sweeping legislative changes in an attempt really to make sure that what has happened in the last several years in real estate doesn't happen again, and their latest round of new regulations will directly impact how you do business. Now, first and foremost, all real estate professionals must come to the realization that the era of quick closings are really going the way of the dinosaur. Anybody that continues to write contracts for 30 days or less is really just asking for problems, delays, and upset clients. In all reality, we're likely going back to a 45-day standard for real estate transactions. Well, 45 days if you want to have fewer frustrations for you and your clients, whether they're buying or selling. In a nutshell, really there's several regulatory forces coming together in hopes of forming a safer real estate lending environment for the consumer. So far we have HERA, the Housing and Economic Recovery Act, working within HOPA, the Home Ownership and Equity Protection Act, which is working within the Reg Z portion of the Truth in Lending Act. And I know that's a mouthful, isn't it? So basically we've got the government trying to protect the consumer, but in doing so they're adding more costs to the transaction, they're adding more time to the transaction, and they're adding more difficulty to completing the real estate transaction. Really, you know, it's not going to be a huge deal if and only if those of us in the real estate industry can work together for the best interest of the consumer and make some adjustments to how we do business. All right, I know you're asking, all right, Kurt, what exactly does it mean to me, my business, and my clients? Well, let me first give you some details and then we can explore how it can impact your business. Just so you know, this rule is for all loan originators, whether they work at banks or brokers or mortgage banks. And therefore, purchase and refinance loans on owner-occupied and second homes that are 1 to 4 units. It'll also include second mortgage loans, but does not include second mortgage lines of credit or HELOCs. All right, so at the time of application, the only fee that can be collected from the consumer is for the cost of the credit bureau. Absolutely no other fees can be collected until the client has received the initial loan application with all the required disclosures. If the lender happens to mail those forms, you must wait 3 business days, so fees like appraisal and application fees can't be collected until the 4th business day. Now, if the application is done face-to-face, those upfront fees can be collected at that time, assuming that all the documents, the upfront documents are given to the client at that time. Another way to speed up the process is if the lender would email or fax the loan application and has the consumer sign an acknowledgement upon receipt of the email loan application. And once that acknowledgement is received by the lender, those upfront fees can be collected. So this also means that no appraisal and no title work can be ordered by the lender until one of those 3 standards has been met. Now, even if we do shorten when the upfront money can be collected or the appraisals and title can be ordered, loans still cannot close until an initial 7 business days has passed. Now, I know that 7 business day closings are not that usual in real estate, but there are many consumers that go to lenders that advertise those quick closings. And it would appear that these new regulations, since they're now enacted, that those quick closings are all but gone. Now also, before the loan can close, the borrower must receive a copy of the appraisal at least 3 days before closing. Now they're still working out the logistics of this, but it appears that it will have to come from the appraiser. It shouldn't be a problem, but it's just something else that could slip through the cracks to delay your closings, and I wanted to make sure you were aware of that. Now next, and more importantly for your closings to happen on time, is if there is more than a 0.125% deviation from the last APR disclosure. APR is annual percentage rate. it's got to be redisclosed before you can close. So that means if they mailed a redisclosure, okay, there's a 7 business day delay in closing. 3 days to receive it, and then there's the 4th day, and then after that's when the 3-day review period begins. So it could delay a closing 7 days. Now you could shorten that delay to 3 days by redisclosing via email or fax with a quickly signed and returned acknowledgement from the borrower. Now I want to say this again because this is the most important thing. If the final APR, the annual percentage rate, on the final TIL, the final truth in lending, deviates more than 1/8 from the last disclosed APR, the minimum your closing is delayed is 3 business days. But it could be as much as 7 business days. Now this is huge, folks, and it's the main reason that I throw out that 45-day closing is probably better than the 30-day closing. Now all in all, this does have some good and bad results. The good would include making sure the client has some time to realize that a lender has perhaps lied to them and raised fees, rates, or both. Another positive will be that most lenders will have to have all their numbers to the title company 4 days before closing so they can get a final truth in lending to make sure that the APR, the annual percentage rate, does not deviate more than 1/8. If the APR does deviate more than 1/8, then there's time to redisclose to the client before missing a closing date. Now, if the lender would try to keep it higher than what the client originally signed on for, well, then there's some time for you and your client to either convince the lender to honor the original quote or work out a revised closing schedule allowing you to go to a new lender. Now, I can see where this would eliminate those last-minute closing issues and surprises, and in my opinion, that's a good thing. Now, the bad part of this is that it extends how long it takes to get loans approved, and it can delay closings if the lender doesn't know what they're doing or trying to pull one over on the client. Extended closing times cost the client more because a longer rate is locked, and the longer the rate's locked, the more expensive it is. Another issue could be that with a client that desires to let their interest rate float. Unless the interest rate that's locked is the exact same as what was initially disclosed, a redisclosure and a new 3 to 7 business day waiting period starts again. So the sooner the client locks their rate, the less chance there will be delays in closing. So your client will likely need to decide which is more important to them, closing on time or trying to time the market to get the lowest rate. Now, folks, this change is just another in the line of industry adjustments that continue to come our way. In fact, we've got another one scheduled for October 1st of this year, and then another one for November 1st of this year, and yet another one in January of next year. And to top that off, the Fed's still working on other changes that will likely be implemented next year. Frankly, your job and my job will be totally redefined in the next 12 to 24 months. So if you want to stay in business and be successful, you need to be ready, and more importantly, you need to align yourself with a lender with the ability to change how they do business and have a proven track record of delivering on those promises. So the biggest nugget you can mine from this video really is to start writing 45-day contracts. It's going to make things run much smoother for you, for your client, and also for your lender. If you'd like to know some specific strategies that you can implement to improve your business and better protect and provide for your clients, or you would like to be notified via email when we update our New Reality of Real Estate Don't Get Blindsided video series, you can call me at 816-415-1737 or email Kurt@kcmortgageplanning.com, and I'll be happy to meet your needs. Thanks for watching the video, and if you found this information helpful, please forward the link to your fellow real estate professionals. I appreciate it. Have a great day.